What a difference a year makes. Tomorrow marks the one-year anniversary of the Christmas Eve market collapse. The S&P 500 plunged 2 3/4%, briefly slipped into a bear market. But look how far we've come. The S&P up 37% since then, hitting new all-time highs. And our next guest says more records are on the way. BTIG's chief equity and derivative strategist Julian Emanuel sees the S&P 500 hitting 3450 next year. I can't even believe I'm going to read this next number. It says you think we could even approach 4,000 on the S&P 500 next year. Mr. Bull, nice to see you.
Great to be here. Under the right set of circumstances, we can. What's fascinating to us is that, you teed us up previously, one of the biggest bulls on the street. We're only looking as our base case 7% upside. And what's amazing is that when you look at the past history of years following good years like 2019, the average return is over 14%. That's the kind of ingrained, really, defensiveness that we've seen the entire year, leading stocks higher, and then we still think there's plenty of going into 2020.
Yeah, but how many of those following years happen to fall in an election year? There's a lot going on next year, especially in the second half. The market can withstand all of that?
There is a lot going on. We certainly think that the runway is reasonably clear in the first half. If you look today, I think we could all argue that given the rally that we had the last couple months, the market is overbought on a very short-term basis. But when we look at things like the hedging structures going out past the election, the profound sort of fear of a good economy, politics that seems to be working in the favor of creating economic upside, it seems sort of irrational to us in a lot of ways.
What about earnings, though? I mean, all of the things that you said are working, earnings aren't exactly working.
Well,
you better have earnings.
And we think you do. We're looking for slightly under 7% growth, really consistent with sort of, a stabilizing global GDP scenario. Places where, Europe, things seem to be looking a little bit better politically. Obviously, the U.S. and China looking better. USMCA about to go into effect. It's really sort of normal when you take the last 2 years into consideration, a juiced year from tax, and then this past year, which was too difficult to comp versus the previous.
So let me ask the economist here at the table. Does that 7% earnings growth sound reasonable to you?
Yeah, sure. I mean, this year's earnings were lousy for reasons you mentioned. The market did great. The economy next year could. It was all multiple expansion. Economy next year could grow 3%. Nominal could do 5%. Corporate profits could do 10%. I mean, I'm pretty upbeat. I mean, look, the Fed pivoted. All the internals of the market are telling you that the economy should do better. The cyclicals advancing, industrials, yield curve steepening. So, I mean, if the economy does well, that is also going to remove the political risk, because the unemployment rate could be at 3% next year. If the economy grows at 3%, I can make a good case the unemployment rate ends the year at 3%.
And I would say that if the economy is going to grow at 3% next year, and remember, consensus is right now around 1.8, 1.9. We're looking for 1.9. That's a recipe where you don't even necessarily need, the investing public to, quote unquote, fall in love with stocks again. That's going to get us well beyond our price target.
Everything you guys just said sounds like a recipe for the Fed. I mean, how does the Fed stay out if you get 3% growth and we've just chucked, a $250 billion of balance sheet at the problem also in the last couple of months? Any whisper of the Fed changing their tune, I think, will scuttle this whole thing.
The Fed's not changing their tune. First off, if you get much past the first quarter, whatever the Fed does is going to look political. And after the last couple years,
not going to do anything in an election year, right?
Exactly. And, so behind the scenes, they're going to continue to support the money markets. They're going to buy bills at the short end, which will gently expand the balance sheet and gently cause the yield curve to continue steepening, both of which are very important for confidence.
Julian, when do we make the high in the market? Can it be mid-year?
It could be. Again, it really depends on the degree to which, for us, it's very important. We actually think that global bond yields bottomed very significantly in August, September. And what we think is likely to happen for the first time in many years is that the public will see that there's the potential for capital losses in their bond funds. They'll see that how large their money market balances are. They'll shift into stocks. It just depends how quickly that occurs. We don't think it's likely to be sort of a whoosh. We think it's likely to be gradual, so stock prices could stay supported.
Appreciate you being here. Thank you.
Thank you. Happy holidays.
All right, Julian, you as well. Thank you. What do you guys think?
Well,
base case and best case are, far apart, but
I think there's a lot to like right now. I think and there's really not a lot to dislike right now. Other than short-term sentiment running really hot, I think prices continue to move up. And if you look under the hood, market breadth is extremely strong. We're seeing advanced decline line making new highs. So we're not really seeing any divergences in the market right now, which I think is really key. So while this continues, and the groups that are making 52 highs are just all over the place. It's consumer staples, it's tech, it's agriculture stocks. So I think just riding the trend is really where to be right now in the market until things change.
Yeah, I mean, listen, being bullish is being right this year, without question. I mean, here we are at all-time highs, but there are things to be concerned about.
There is a degree of bullishness, though, that one has to entertain, whether it's 34, 50, or 39.
Yeah, 39.50. I mean, in my world, 3,400 is a reach. 39.50 then is a serious reach. But when you talk about S&P market cap to GDP, we're talking about 150%. I mean, those are historic levels. Consumer debt, albeit at low interest rates, north of 50%. Even corporate debt is at ridiculous levels. A lot of things to be scared of, but it doesn't matter because the market goes up every day, and the market is the ultimate arbiter. It's a way of making people that are trying to throw some cold water on this very foolish.
Two things. If you just normalize where we went from in the fall of last year and kind of take it from November levels, we're only up 13% on the year. In other words, that drawdown from year end and starting the year, basically Jan 1, was artificially low. The numbers aren't as impressive, and that's good for the